But we'll go ahead and get started. My name is JC Finley. I'm the Member Engagement Specialist at the Credit Union. And once again, thank you for coming to our Budgeting to Build Savings class. So what is a credit union? If you're not familiar with the credit union already, they provide not-for-profit banking products, loans, and services. Credit unions are owned by their members who have a say in how the credit union is led and operated. Every member is an owner, so it's a democratic financial institution. Oops, the slides are getting jumpy. Every member is an owner. There's a democratic financial institution where members vote for the board of directors, so they have a say in how the credit union is run. The credit union difference is we are for people, not for profit. So this is just kind of how a credit union works. So first, you deposit your money with us. We use your money to make low interest loans to fellow members. That profit made from those loans is put back into the credit union, and that is returned back to our members as better rates and fewer fees. At Denver Community, our mission is to educate, deliver, and achieve. We are a not-for-profit financial institution that has served Metro Denver since 1934. This class is a part of our free and award-winning Clear Money Financial Education program. This program includes live classes, coaching, and e-learning courses that are available on our website in both English or Spanish. Our one-on-one financial coaching is available via Zoom or by phone to answer your personal finance questions and help you reach your savings, budgeting, credit, and other financial goals. You can request a financial coaching at denvercommunity.coop/coaching, and we'll get in touch to schedule a time that works well for you. So first, we're going to start with just a little icebreaker here. So why do you want to set financial goals? If you could just respond in the chat box, it'll kind of get us talking why you want to set financial goals, what goals you may already have. So feel free to send those in the chat box and we'll kind of discuss, or Sarah may read those aloud. So paying off credit cards, less debt, saving for a home.
Credit cards.
Go ahead, Sarah.
Less
Sorry about
debt, finding an affordable home, paying off medical bills and funding a business, paying off student loans, build savings and be able to buy a home someday. Fantastic. Building an emergency fund. That's a great goal. Saving for a home, reducing debt, no more credit cards, having control over budgeting and buying a house and an emergency fund, saving for retirement, which is also fantastic, and generational wealth building. I like that. Awesome. So yeah, great suggestions. Feel free to continue to type them in the chat box.
Those are great. Thank you all for sharing your goals. Those are all fantastic. I have a lot of those same personal goals myself, saving for a home, retirement, financial security, awesome goals. Thank you all for sharing. So financial goal setting. Why do we set financial goals? We want to develop a roadmap or a plan to achieve our goals and stay on track. Goal setting will help you with your everyday financial decisions after you set smart financial goals and empower you to move closer to the future you want for yourself. This will help give you a long-term vision and keep you motivated in the short term. So for me, having my long-term goals helps me stop impulse buying. It helps remind me, I'm saving up for a house. I don't need this extra pair of shoes or this extra lunch. I can eat at home and I've got plenty of shoes that I can already wear. Your goals should tie into your values. If you value financial independence, your goal might be to build savings or pay off credit card debt. If you value family, your goal might be to save for your child's education. Now, long or short-term goals. At the credit union, we define short-term goals as any goal attainable in 1 to 2 years, and a long-term goal, anything achievable in over 2 years. And I have a lot of members ask me, do I need long-term goals? Do I need short-term goals? And my answer is you want to have a little bit of both. If your long-term goal is to have a comfortable retirement, your short-term goals might be to pay off debt, reduce your expenses, and increase your contributions to your retirement funds. Big and long-term goals can take time, so it's easier and best to break them down into smaller, SMART goals that you can use as stepping stones on your path to reaching those long-term goals. Try and set some goals for yourself by the end of the week. Add a reminder to do so. Most people, including myself, have a tendency to procrastinate. Give yourself a deadline or tell one of your friends your deadline so they can check in on you and ask if you started working towards your goals. So, setting SMART goals. What elements contribute to making a good goal? Research finds that people are much more likely to achieve a goal if it's written down and tied to a plan. We'll go through each one of these aspects of SMART goals over the next few slides. So first we start with S, stands for specific. So make sure the outcome of your goal is very clearly defined. So a good example would be save money for an emergency fund. Someone said that earlier, so great job. You don't want to set a goal like I should save money at some point. Instead, you want to give your money a purpose by tying it to your values and your priorities. So M stands for measurable. How will you know if you're on track to meet your goal or if you've met it already? You want to give your goals an exact dollar amount. So we'll use a running example throughout this SMART goal process here. So if you want to save $1,000 in 1 year starting today and you're paid weekly, you can calculate how much you need to save from each paycheck to meet your goal in 1 year by dividing 1,000. In this example, I'm going to use 52. So this would be someone who's paid weekly, and that's the number of weeks in a year. So that's just each paycheck. In this example, you would need to save about $19.23 out of every paycheck to meet your goal. And you can track your progress over the course of the next year by calculating the percentage of $1,000 you've saved. So A stands for attainable. It's great to challenge yourself and think big, but you want to make sure that your goals are realistic and take into account your bigger financial picture. In this example, you'll want to make sure that you can realistically save, $19, $20 every paycheck while meeting the rest of your financial obligations. Cutting extra spending is a great way to free up some cash, but likely bills and other expenses are non-negotiable needs. Keep in mind that you can always update or revise the dollar amount and other elements of your goals if you need to make sure they're more realistic and achievable. You can also make trade-offs that you may need to make. If your goal is to save this $1,000 for an emergency fund and you have some unexpected expenses come up, you may need to stop or temporarily decrease the amount of money you're setting aside for this emergency fund so you can look out for your overall financial well-being by paying your bills on time, for example. So R stands for relevant. So what is the value that drives this goal? And does your goal fit with your overall financial priorities? So in our running example of saving $1,000 for an emergency fund in 1 year, it would align with a long-term goal to eliminate and not take on any additional credit card debt. By building emergency savings, you can avoid racking up credit card debt, so your short-term goal is relevant to your bigger value of financial security. We all know that our priorities do shift over time, but your goal should align with your current and top priorities. So T stands for time-based. So you want to determine exactly when you'll start working towards this goal and when it will be achieved by. So ask yourself, in this example, for this $1,000, are you going to start saving today, tomorrow, your next paycheck? So we already established we want to get that emergency fund, but it is very important to establish when you're going to start saving and when you want to accomplish that goal by. With that date, you can develop an accurate plan of action to reach it. So in our example, this allows you to know how much money you need to set aside for your emergency fund every month or out of each paycheck. So we take that $1,000 by 52 paychecks, and that gets you that $19.23. If you're a monthly employee, you'd take it divide by 12. If you're a bi-weekly employee, like myself, you'd take it divide by 26. And that will get you how much you need to save per paycheck. And we'll go a little bit more into that when we go through the budget. So tips for success with financial goals. Goals don't always have to be complicated. For the goals you're setting for yourself, it can be something as simple as I'm going to open a free savings account and then build more goals from there. So tip number 1, write down your goals, whether it's on paper, on your phone, on an online document, just write them down. Your goals are more concrete and likely to be achieved if you write them down. I personally like to write them down on paper because if I put them in the notes in my phone, I end up forgetting about them. Tip number 2, state your goals as positive statements. I will instead of I won't statements, so that they're positively worded, and use action verbs. So a good example would be, I will save more money, not I won't impulse buy. That's not a very good example because it's not specific like we just went over, but just some context for showing you the I will versus I won't statements. Tip number 3, measure your progress at predetermined intervals, whether it's monthly, once every 6 months, annually, kind of depending on your goal. If it's a short-term goal, it may make more sense to check in, quarterly, or if it's a long-term goal, it may make more sense to check in once every 6 months or once a year. Review your goals and adjust or update them as needed. If your life, work, or financial situation changes, visit your goals and make sure they're still achievable and align with your current values and priorities. So tap into some visualization with creating financial goals. So why did you set this goal for yourself in the first place? And visualize how your life will be different and how you will feel by achieving this goal. How will you feel if you don't accomplish this goal? Use those feelings to motivate yourself and stay on track. So for myself, whenever I'm thinking of buying something impulsively or mindlessly, I think about how much I'm saving for a house and how bad I want to be moving into a house and how great it's going to feel when we finally get to sign and close on a house someday and move all of our stuff in. So that's one way that it motivates me. Everyone has setbacks. It's how you deal with them that matters most. If you get off track, adjust accordingly, but don't give up or allow temporary setbacks to deter you from reaching your goals. Your goals may need to be adjusted, emergency happens, life happens, 2020 happened, but continue to set and work towards your goals. Like a GPS, we may take a wrong turn, but you want to get back on the path as soon as you can. So even if you have to stop saving for some goals for a certain period of time, don't forget about them, just get back on track when you can. Money personalities. I loved learning more about my money personality. So understanding and being conscious of your money personality is very, very helpful for deciding how you're going to manage your money. It's important to understand your natural tendencies towards money management before you adopt a budgeting system that works really well for you. We're all very different, and the better you understand your money personality and your money management tendencies, the better you are to tackle your financial goals armed with that knowledge. So right now, we're not going to take this personality quiz, but take it on your own time. There's a lot of great information here, and here's the link you can use. You'll be provided with practical advice for your predominant money personality. So you'll take a quiz, it'll look at what your predominant money personality is, whether you're a spender, a hoarder, an avoider, you name it, and it'll give you information on how to tackle that money personality. The truth is, no one will ever care more about your money than you do. So when you have goals that are meaningful to you and you're motivated to achieve them, you're more likely to make trade-offs and shift your spending habits to achieve those goals. Changing your spending habits is not easy. I tried changing my spending habits for a long period of time, and it's something that does take time. I'm a visual person, so when I was saving for my vacation, I took a little piece of paper with an airplane and taped it to all of my cards to remind me of that big goal. It was a priority check to me every time I pulled out my card to buy something I really didn't need. Now that piece of paper is a house, as I just mentioned, and I have it taped to my bathroom mirror, my fridge, anywhere around my apartment. So I remember what I'm working toward. And if I've had a hard day and I want to spend mindlessly, many of us have that feel-good chemicals when we spend more or shop. It makes me take a step back and think about why I'm spending sometimes. So for me, as a visual learner, having those visual cues around me have been really, really helpful to help with my impulse spending or mindless spending if I had a bad day. So spending plans, AKA budgeting. Why do we do it? You want to know how to free up your money or set aside how much you have for financial goals. You want to know exactly where your money is going and give it a purpose. I like to reframe the word budget and calling it a spending plan. So how I'm spending and prioritizing my money and goals, not how I'm depriving myself, because that's kind of how the word budget sounds. Like, I don't have enough money and I got to budget it, but a spending plan really just allocates where I'm spending my money. Everyone has to make trade-offs and prioritize what to spend their money on. There's no end to what we could spend our money on, at least for me anyway. So why develop a spending plan for yourself? So you can save money in the way that makes sense for you and your financial well-being. It also sets aside a pretty regular amount that you're saving. So for me, before I made a budget, I had no idea how much money I was saving until I started making my spending plan, working on it regularly. I know how much money I'm saving typically every month. A budget gives your spending and money a purpose. You don't neglect your overall financial goals or wonder where your money is going. And it's not always about how much money you have, it's about managing your money. So we have a poll that we'll launch here just to kind of show you about money management in just a second. Of course, if you don't have the income to meet your most basic needs, housing and food, for example, you'll need to find a way to increase your income or reduce those expenses. So let me launch a poll here. So, according to a Sports Illustrated study, what percentage of NFL players file for bankruptcy 2 years after retiring? What do you guys think? 34, 56, 65, or 78%? NFL players earn a lot of money. All right, we got quite a few responses. I'll wait a couple more seconds. Awesome. So it looks like the most selected answer was 65%, but in actuality, 78% of NFL players are filing for bankruptcy or are having money issues after just 2 years. I mean, NFL players are making millions and millions of dollars a year. So I think this is just a really great example to show that money management is so important. Even if you have a lot of money, if you have a little money, if you're somewhere in the middle, money management is huge. Such a great life skill. Thank you to all those who contributed in the poll. So here's the results. Most people voted for 65%, but in actuality, 78% of NFL players are having money problems after just 2 years. All right, we got one other poll question here for you. So this one, please just respond in the chat box. What is the first thing that comes to your mind when you hear the word budget? Could be good, could be bad, could be ugly, you name it. I know when I originally think of budget, it's not always a fun word to think about.
So some of the answers that are coming in are frugal, diet, restriction, prioritizing, not having enough. These are all great examples. I think that word really solicits a lot of different feelings in different people. Less income than necessary expenses, anxiety, meeting your budget, great.
Absolutely. These are all great answers. I know when I think of budget, I can get a little anxious and nervous too.
We got another one that says expenses and income.
Absolutely.
And yeah, you know, the budget, whatever you want to call it, and JC will dive into this a little more, and reframing it as a spending plan, what it looks like, really helps you achieve your goals. And After we discussed the goals last time, we had a few more come in that were fantastic. Teaching your son how to save because they never learned when they were young. That's an amazing reason to set goals and work towards them. Being able to know when you're spending too much. So I really appreciate, and I know JC does too, everyone's willingness to share. And then we got one that says stressful. Yeah, managing money can be stressful, and the idea of a spending plan or budget is to make it less so. And JC will take it from here.
Awesome. Thank you so much to everyone who contributed. I know I feel the same way. When I hear the word budget, it can be a little scary. All right, so we're going to dive into a spending plan example here. This is just an example, and this is going to be based on someone who is paid weekly. So this is a weekly budget. We also have several other budgets for bi-weekly, monthly, and we can send you a copy of this budget that already has some of the formulas in there and everything, or just a blank budget as well. So Sarah will either put my email or her email in the chat box so we could reach out to you to give you that budget spreadsheet. So we're looking at Joe's income. This is Joe here. He is paid $500 weekly. Budgets or spending plans, as I like to call them, all start with your income. When you fill out your budget, be sure to use your take-home pay. So what this means is the amount of money you receive after taxes, health insurance, and employer-sponsored retirement dollars. So that's all taken out already, so you want to use the money after that. If Joe had any other income from a part-time job, a side gig, maybe child support, that money would also be added into the income section as well. If your income changes week to week, maybe just do an estimate on what you typically take home or the lower end of what you take home, or maybe do an average of your typical paychecks. So the next section is savings. We always recommend doing savings and paying yourself first. So Joe is setting aside $40 from each paycheck for savings. This leaves him $460 left over for his weekly paycheck. He currently has 2 different savings goals that he's working towards. So he's got set aside for $30 from every paycheck for emergency savings, which is awesome, and to save a total of $500 a year for a trip to Michigan to visit his family. To calculate the amounts of money he needs to save to reach to $500 in 1 year's time, he divided that amount, $500, by 52, which is the number of weeks in a year, to get that amount. Please don't get discouraged about saving money if you can't save a lot to start. What's important is develop the habit of saving money, no matter how little you start with. As you earn more or reduce your expenses by paying down debt, for example, you can gradually increase the amount of money you're setting aside to your savings. Decide on an amount that makes sense for you and know that you can increase or decrease that amount moving forward at any time. For example, you don't want to be putting so much money into savings that you're going to end up paying late or overdraft fees. Even if you're paying off debt, put some money into savings so you don't have unexpected expenses arise that will dig you further into debt later on. You can always have a debt repayment savings account that you can use to pay off larger chunks of debt at one time. So like I mentioned, we go from income to savings. Savings is paying yourself first, because I remember when I used to budget, I used to put my savings at the end of the month. You know, whatever was left over, I'll put that into my savings account. But what I noticed is when you wait towards the end of the month, there's not a lot left. So it's very important, if you can, to do income and then savings first. So what I do is I have an automatic transfer every payday to go into my savings. So that way I don't even have to think about it. Just automatically on those Fridays, it sends money to my savings account and I don't even have to think about it, which is really nice. Next, we have fixed expenses. These are expenses that typically don't change month to month unless you were to move, cancel, or maybe upgrade a service. In this example, Joe's student loans are currently in deferment, so he's not making student loan payments at this time. The reason this spreadsheet is set up for weekly expenses and spending is to make it easier for Joe to know exactly how much money he has to spend and save from each paycheck. It also makes things simpler for him if he wants to set up an automatic savings transfer or bill payments, because he'll already know how much money to have set aside for his different spending categories. To cover all of these fixed expenses, he's going to need a total of $251.54 out of each paycheck, which leaves him with $208.46. Because some months have longer or shorter weeks, or shorter months, you may need to take the monthly bill, multiply that by 12, then divide by the 52 weeks. And we can email you, as I mentioned earlier, a template that already includes these math formulas. For your fixed expenses, I recommend always paying more than the minimum amount due for credit cards so you can pay them off faster and save money on finance charges. I know I have a credit card that the interest rate's like 22 or 25%. There are other items you can add in this section depending on your fixed expenses, like a gym membership, prescriptions, childcare, any of those. So fixed expenses will vary per person, so there is room for you to add these or remove some if they don't apply to you. Set aside money. So these are non-monthly expenses. This was personally one of my favorite things to learn about when taking this class, was this overall concept of set aside money. So non-monthly expenses are expenses that you don't have every month, but they typically come up at some point during the year. This is a spending category that most people, including myself, have struggled with and are caught off guard by this because we only really think about things that go into our month-to-month budget. I know I personally, before taking this class, never thought about saving for an oil change or to go to the doctor or anything like that. I always just thought about stretching my budget to make it work. By setting aside money for these non-monthly expenses out of each paycheck, larger expenses that Joe or myself or any of us may have become a lot more manageable, and he's less likely to need to borrow or rack up debt to pay for. For example, instead of suddenly having to come up for money for car tags, he's been setting aside about $7.70 out of each paycheck for that. Unless he has to get a new car, your tags will typically be the same as they were last year or less, which is nice. Divide that amount by 52 weeks and estimate what car repairs you may have to save for so you're not caught off guard. To save for all the non-monthly expenses listed, Joe is setting aside $33.27 from every paycheck, which leaves him with $175.19. It's a form of short-term savings tied to a specific spending. There are many other non-monthly expenses you might have, so take some time to brainstorm what they may be. Some examples may include dental bills, vet care for your pets, annual membership dues, and insurance premiums. I personally have a whole car savings that's just made for saving for oil changes, for my car tags, for my tires, and it's been great. I used to feel a lot of guilt pulling from my savings when I had to pay for things like new tires or my car tags, but now that I have everything in a specific set aside savings for those items, I feel guilt-free pulling out of that savings account, which is really, really nice. So variable expenses and fund money. These are things that will vary from month to month or even from week to week. These are expenses where it's easy to overspend for Joe, and I know I personally overspent in these categories in the past. He sets aside for each amount a little bit more flexible because he can't control all of these expenses, such as the rising cost of gas or food. Joe needs about $120 out of each paycheck to cover groceries, gas, and other discretionary money to spend on whatever he considers fun for him. You should track non-fixed spending categories such as groceries, eating out, and entertainment every now and then so you have a realistic estimate of what you're spending and don't wonder where all your money goes. I know for me, that's where I wonder where all my money goes. After I go to the grocery store, after I go out for a couple of drinks with my friends, I just feel like, where did all my money go? So that's why it is important to keep track of these variable expenses that vary from week to week. Pick one or two spending categories and focus on them during a specific period of time to get them under control. I personally did that with my grocery budget for about 3 months straight, and it was really, really helpful. I just zoned in on my groceries and really made sure I was staying within budget. And after I did that for about 3 months straight, it became very consistent for me. It's best to track spending for 1 month, but I would recommend tracking spending on different categories for at least 2 weeks minimum. While it's great to have a budget or a spending plan, be sure to update it periodically when your income or expenses change, or at least once a year so it remains relevant and accurate. So if you move, you get a new job, get a new car, those would all be great times to relook at your budget and make sure everything fits. So I know the Excel spreadsheet isn't for everyone, so this is kind of a different look at budgeting or spending plans. So we call it bucket budgeting or a spending map. It's good to know how much of your money allocated and spending on how much you allocate and spend on different spending and budgeting categories. But you also need to know where you are and make sure you keep your money so it works for you in the most efficient way possible. We'll continue using Joe's income for this budgeting map example, and we'll start with income. In this case, it'll be $500 for his weekly paycheck. Then we have our savings, fixed expenses, set aside money, variable expenses, and fund money. These are all the same numbers we just went through, but in a different format. I really like this one because it's color coded too. So you can see here all the savings are all orange, and we'll keep going through. So it's kind of nice for those visual learners. So Joe has clearly defined savings goals. Some people put all of their savings in the same savings account, but I recommend that Joe and most people keep their emergency savings separate from their other savings. In this case, Joe will be more able to easily tell what's emergency savings he's accumulated and what his other savings are. So there's his emergency. And then he was saving up for a trip to Michigan. So I would recommend that he keeps these savings separate. There's no right or wrong answer because it depends on what makes the most sense for Joe and what he's most comfortable with. Because he's not planning on using this money for more than a year, he has options about where to keep it. Joe could choose to deposit this money into a goal for a standard savings account. Many financial institutions will allow you to have multiple savings accounts free of charge as long as the balance for each account remains above zero. I know I have it like that. I have like 4 different savings accounts for each one of my goals. And it's great because I was able to open them for just $0 and deposit the money in there once I got it. Since Joe wouldn't be traveling to Michigan for a while, he could place the money into a certificate of deposit or a CD. He would look for a CD that allows him to make monthly deposits that he would decide on the term, meaning how many months he promises to keep his money in the CD. Could be 6 months to 11 months in his situation. By placing this money in the CD, he'll be more likely to not spend this money, and the CD rate would earn a higher interest than just sitting in a regular savings account. So with longer term goals that are maybe 6 months to a year or even more than a year, a certificate of deposit could be a great spot to keep money for that goal as long as you can keep adding to it. So next we have fixed expenses. So we have our total of $251.54, and I would recommend that a checking account would be best to cover Joe's fixed expenses. From his checking account, he'd be able to pay his bills through his debit card, checks, in cash, or through online bill payer. Joe will pay his bills on time or before the due date, so that makes the most sense for him. He can pay his bills early after he receives his weekly paychecks or at the beginning of the month or anytime each bill is due. I personally always try and pay my bills a few days ahead of time just to make sure if there's a lag or processing, anything like that, my bill is paid on time. Set aside money. So you have that total of $33.27 he's going to set aside for those non-monthly expenses. So he needs to find a way to keep this money aside so he doesn't spend it on unplanned purchases, but keeps it for those non-monthly expenses he's planned on. Where to keep? It kind of depends on your personal preference. Joe could keep this money in a separate savings account so he could transfer money for specific non-monthly expenses to his checking, or he could also deposit set aside money into his checking account and be careful not to use it, or open a separate checking account for just his set aside money. I personally just have a separate savings account with my set aside money in there. So variable expenses and fund money, we said that was about $120. And where to use this to make it easy to access? I would say checking account. And since these are weekly expenses, checking account would make sense since you're going to be using this money frequently. One main reason that the expenses in this budgeting system are set up to be weekly is to make it a lot easier for Joe to understand his spending. Joe needs to put about $120 of each paycheck towards his variable expenses and fund money. And by fund money, I just mean anything that he can spend on whatever he wants, whether it's going out with friends or if it's, new shoes, you name it, anything that he wants for himself. And I highly recommend including this in your budget, including your own fund money, just because when I was budgeting for a while, I didn't have that money in there and it felt really constricting. It felt like I couldn't spend any money on myself. So setting aside that fund money gives you some wiggle room and allows you to spend more money on yourself. If he doesn't spend his fund money one week, he can spend it the next or just keep it in his savings to treat himself something nice down the line. So the best place to keep this money, I would recommend keeping this in the checking account. Joe is no different. A checking account is the most logical place to keep majority of his spending money just because you'll be making these purchases every week. To keep spending under control, there's a few different options here. So Joe could only take out the amount of money he's willing to spend with him when he knows when he's out with friends, for example. Joe knows that he tends to overspend on two expenses, coffee and drinks and miscellaneous fun. According to his budget, Joe wants to spend no more than $10 per week on coffee and drinks. So he has a couple options to make sure he doesn't overspend. One, as we listed here, is the cash envelope method, where he will carry the amount he allocated to himself to spend, $10 a week, and when he runs out of cash, he stops spending money on that expense. If Joe is not comfortable carrying around cash, he could be open to a no-fee or low-fee prepaid debit card or stored value card. That's what we call it at the credit union, where he can transfer only the money he is willing to spend on this card. When he runs out of money, it will decline so that he can't spend anymore until he reloads more money on the card. Those cards can be expensive, so make sure to do your research. Some financial institutions, like where I work, offer them for free if you have a checking account, and you can just transfer the money online or from your phone. These are great for giving kids allowances or loading your own spending money on them. I personally used a prepaid debit card for a while when I was overspending on groceries, as I mentioned, and on my fund money. I uploaded all my grocery and fund money onto that stored value card, and it helped me a lot with tracking my purchases and not overspending. So I noticed I was struggling to track all of my my weekly expenses, those groceries and coffee, things like that. So the stored value card was a great option for me to help with tracking and to help me not overspend. Some resources. So we have worksheets, spending plan templates, strategies to pay down debt, money personality quiz. We don't have a handout here, but we are happy to send these links. Sarah sent the link for the money personality quiz, and we can send out the PowerPoint as well. We can schedule free one-on-one coaching sessions. So if you have, personal questions you'd like to go a little bit more in depth with, you can schedule a free one-on-one coaching session with one of our financial coaches. They're a great opportunity if you want to build a budget, pay down debt, build credit, you name it. We can go over a ton of different personal finance topics. Or if you're just trying to figure out, maybe what direction you want to go with your financial goals, we'd be happy to sit down with you. We also have our free e-learning courses in both English and Spanish. They cover a ton of different topics, including building savings, protecting identity, home buying, family conversations about money, and tons more. There's no download or email sign up required for these. They're accessible 24/7. So I highly recommend taking advantage of these. They're about 5 to 10 minute courses. Really, really great resource there. And lastly, wrapped up a little bit early here, but I am open to questions. I'd be happy to answer any questions that you all may have.
So JC, I'll give everyone who's attending a moment to type into the chat. I
Mhm.
did receive a question directly that I think may be helpful for others too, which
Yeah.
is what fees are associated with opening additional savings accounts? And my response was that it really varies by financial institution.
Mhm.
And that at Denver Community, so at our financial institution, you can add additional savings accounts and open them with $0, and there are no monthly fees. But it really can vary, the minimum to open as well as monthly fees depending on the credit union or bank.
Yeah, absolutely.
It, yeah, and those are just such a helpful resource to tie your goals to different savings accounts. That's something that's helped me quite a bit too. We did receive a question from Kristen. What effect does having multiple savings or bank accounts have on an individual's credit score? Do you want to take that, JC?
Yeah, of course. So having multiple savings accounts or multiple bank accounts will not impact your credit score really at all, unless you were to, overdraft and not pay those and things like that. But just having multiple bank accounts or multiple savings accounts will not hurt your credit in any way. So I personally have 3 different financial institutions that I use, and I think I have a total of about 5 or 6 savings accounts. And that's just me. I just like having a savings account for each one of my goals. And I like having my savings separate from my regular money that I spend monthly. So having multiple savings or multiple financial institutions will not impact or hurt your credit score.
Yeah,
Sorry if there's,
absolutely.
sorry if there's
Thank
anything
you
you want to add.
for
Go ahead.
Yeah, absolutely. So what JC says is accurate. Your savings accounts and checking accounts never show up on your credit reports. And the only way that an overdraft would is if you did not pay it for a significant amount of time and it ended up in collections with an external organization from your credit union or bank, because at that point it's considered a debt. So if you have a lot of different banks that you do your banking with and credit unions, a combination, and you have loans with each of them, your loans would show up on your credit reports and be reflected in your scores. But your savings and checking, as JC mentioned, do not impact your credit score or your credit reports whatsoever. And like JC, I also have a lot of savings accounts, each tied to a specific goal, and it has no impact. And the balances, none of the information shows up on a credit report. That's a great question. We received a question about, can the content from this meeting be emailed? Yes, you can send me your email address privately in the chat box so it's not visible to everyone, or you can email JC. That was in the chat stream and I will type that out. Tia requested post the links with the worksheets in the handout. Same thing. We're happy to email those directly to you. We will be sending an email to everyone who attended. Some of you don't have your name, are not using your full name, so it may be hard for us to tell, but we will send a resources email that will include these resources as well. It may take a day or two for that to go out, so if you'd like that this afternoon, please send a direct message to the Denver Community account, which is what I'm monitoring, so that not everyone can see your email, and we'll get the slides and a spending plan to you sooner than the email goes out. Let's see, I'm looking, JC, there's another question we received directly to the Denver Community account. What advice do you have for maintaining a budget with variable income? I am self-employed and income varies by season. That's a great question. I'll let you take that, JC.
Oh, okay. So my best advice would kind of be, as we mentioned, for someone who maybe doesn't have consistent income, is maybe kind of take an average of what you think you make each quarter or what you make seasonally and use that as your budget. You could look back at your last year's pay stubs and paychecks, or just see what your income was during those times last year and kind of average it out. You could average it out for a certain period of time. Or like we mentioned, take the lower portion and use that kind of as your budget, and kind of, if you have increased income, you have a little bit more wiggle room, you can put more into savings. But I think the best with variable income, because I was the same way. I worked at a restaurant for a long period of time and I had no idea how much money in tips I'd be getting in. So what I did is I kind of just took an average of what I was making and used that. Sometimes that kind of bit me in the butt because I didn't use the lower end. I kind of just used a middle average there for like the quarters. And sometimes it was a little bit lower, sometimes it was a little bit higher. But I think taking a good average, or, maybe the lower end of an average to use as your budget, if you're not 100% sure what your income would be a good option. And I'll let Sarah add anything that she can think of as well.
Yeah, that's the same advice that I would provide. Budgeting typically on the lower end. And if you're tracking your income, being self-employed, you're probably doing a lot of tracking for your tax purposes and just in general to see what your income flow is like. You can budget by season. So if you know that there's a busy season for you, you could budget on average what you would earn during busy season. Now during 2020, kind of all of our averages and predictions and things like that may be really thrown off, right? Because we're in a different environment than we were last year or even the beginning of this year. But yeah, I agree. I've had variable income in the past and budgeting on the low end when possible, and then having a plan for when you do have some booms in income. So when it is busy season and more income is coming in, maybe some of that is allocated in your budget to pay down debt or build up savings in ways that you're not able to during seasons where less income is coming in. But that honestly is a challenge for everyone, and something that a lot of people deal with. So I would make a seasonal budget or spending plan, if that makes sense. And you may just want to keep a closer eye on the tracking, keep an eye on what your average income is per week, estimate that on the low end when possible. And again, just have a plan for what to do when more income comes in. That's a great question. Let's see. We received another question, JC. Do you recommend a certain amount for emergency savings? For example, 3 times your fixed expenses or something similar?
Oh, what a great question. This one's always a hard one for me to answer because everyone can provide a different answer for what they think emergency savings should have in there. My opinion, I always like to have around $1,000 saved up in my emergency savings at all times. So my $1,000 was kind of like my minimum. I want to get there and then build on it, because for me, I figured that $1,000 would cover most of my emergencies, whether it was, I had to go to the doctor, or my pet got sick, or my car, something happened there. I typically recommend, $1,000, or more if you can. Other people say 3 to 6 months of, expenses if you were to be laid off, like you said in the example here. But for me and on my income, that can seem a little unattainable at times. So I like to start with $1,000 and move up from there. But I think everyone's emergency savings will be a little bit different just based on their needs and emergencies that they may have. For example, I don't have a home, so $1,000 may not cover, a home repair or something that needs to be done. So I recommend, $1,000 or more if you can. And I'll let Sarah, give her opinion on this one as well, because this one can be kind of up to each individual.
Yeah, so as JC mentioned, this really is a very, very subjective thing. And what I like to tell people is the amount that you're comfortable with. And even that, in truth, is unfortunately, there's no amount of savings that can prevent any foreseeable thing that could happen, right? So a giant medical bill. I've worked with some members who, had a very serious medical diagnosis and had savings, but it still didn't cover everything, right? So those emergencies, those things happen. What you want to think about is, what is an amount of money that would make you comfortable and is achievable? So something I see very often is that people get discouraged because they have this goal in mind of, I need to save $1,000 right away, or I need 6 months worth of living expenses for my savings, and they've never, been able to save successfully in the past. So setting up those building blocks, using those SMART goals, starting small is great advice. So look at your expenses and look at your income. Look at expenses you can maybe cut back on, or trade-offs that you can take to increase the amount of money you're putting into savings. And then from there, build up. For me, I had a goal to build an emergency fund, and I had a certain amount in mind, and I thought I would achieve that goal within a couple of years. And I had some emergencies come up. And so I had to tap into that money, which was really painful. That's what it's there for, of course. But I think we all know how hard it can be to build savings. So when you use them, it can be emotional and not so pleasant. But that is what they're there for. And long story short, it took me, longer. It took me almost a year longer to reach that goal, but that's okay. There was a time I was not able to put money into savings, but when I was again, I put it towards that. Having a plan for tax refunds, for example, or any unexpected money that you have come in, if you receive a raise or a bonus at work, having a plan for that. You can treat yourself a little, but then have a plan of, I'm going to take myself out to a nice dinner, or take out during a pandemic, I suppose, with 10% of it, and then the rest I'm going to put in my savings. A lot of personal finance experts will say, 3 to 6 months of living expenses. Some will say 12. I think a lot of that depends on people's comfort levels, as well as the type of employment that they're in. Now, I don't think anyone saw a pandemic coming, or the type of job layoffs and impacts to all different industries we've seen this year. But in prior, more normal years, for example, if somebody was working at a seasonal job, for example, going back to that example and great question we received earlier, you might want to have more money set aside for savings to weather the seasons where there's not a lot of income coming in, or you have a seasonal job that is an additional job to your full-time year-round job, or part-time year-round job that brings in some extra money. So it really looks different for different people, but I don't want to just say, oh yeah, everyone should have 6 months of living expenses or 12 months. You'll see a lot of different numbers thrown out there, but the truth is, build up as much as you can. And that amount really varies by person. But you'll have other goals too. So emergencies are very important, and that was my primary focus when I first started building savings. And then when I hit that goal that I had, I was able to start building up for other things, for home buying, for a wedding I was planning, and other goals that I had. Retirement is a goal. I was able to put more money towards retirement as I hit that emergency savings. Again, there's no amount of emergency savings that is too much. Or in my opinion, too little, because even if you have a couple $100s for emergencies, or $50 set aside, that's money that you already have there that you don't need to borrow and pay interest on a credit card, for example. You have it available. So I would encourage you to start small and really think about an amount that would make you feel comfortable if something came up. And that looks really different. Some of you might be essential workers where it's really easy for you to find another job, again, not during a pandemic necessarily, and to get rehired. And some people have very specialized jobs where if they experience a layoff, it might take quite a bit of time to find employment. I worked with a member who worked in the oil industry, and when an oil well dries up or is closed, that's many, many people, sometimes hundreds of people, that are all laid off, and they don't necessarily have an easy way to find another job without relocating themselves and their family, which costs money. So I know this is a very long answer, but there is no right or wrong answer. Just think about what makes sense for your priorities, values, and save for that rainy day.
Absolutely. That was a great answer. It's like I said, it's so hard to answer about emergency savings just because everyone has such a different opinion. But like Sarah said, it's great with any emergency savings. If that can cover you, instead of going into debt or credit card debt, that's amazing. So starting small and any sort of emergency savings is awesome.